a view that you have on markets that can maybe has to be viewed as contrarian, and that is your view of regional banks. And we're not talking the stocks of regional banks, but we're talking credit. But the premise is the same, which is that you view the risk in this trade no longer towards default for these regional banks. Is that correct? And if so, tell me how you got there, because this goes back a couple of months. You were telling me
Correct
about.
with the qualifier that I'll add at the end.
Yeah, go.
So we've been interested in the space since September of 22. At the time, when we looked at smaller banks in general, we identified that they carried significant interest rate exposure risk that we felt the market was underappreciating. We put on a trade long big banks where we could really do the deep dive and hone in on exactly this mispricing, this interest rate exposure mispricing. We went long big banks, short small banks through options. At the time, again, slightly contrarian in that it wasn't part of the general discussion. It wasn't part of the gestalt of how we were understanding markets as a collective. That trade was profitable through the end of 22, but really saw its biggest gains as we moved into March of 23 and Silicon Valley Bank's failure. We did not have the view that a Silicon Valley Bank would be insolvent. That wasn't really part of where we thought the trade was, but it worked in our favor at the time. After the failure of Silicon Valley Bank, the market did what I generally refer to as started reading the labels of every package off the shelf.
Yeah.
And fear kind of took over as what risks may be under the hood. We kept our powder dry from March to April as the dust settled around analysis on regionals in general. What we found, though, going into May of this year was that credit was extremely mispriced relative to a triangle of credit, volatility, and equity. In particular, in our analysis, a lot of what we end up looking at is informed by a structural model approach, where you see a bond as being short a put and long some cash. And that's overly simplistic, but I think it's a good guideline for how to understand credit in general. Prior to the failure of Silicon Valley Bank, we noted that the mispricing between credit and volatility and equity was about $14,000 per million if you just restricted yourself to fins. After the failure, that number blew out to about $45,000 per million, which we find very attractive. However, we still noted and were aware of the potential jump to default risk in a single name. So the attractiveness is not in necessarily one name in particular. I think that would strain credulity, maybe even today, but especially back in May. And so what our analysis drove us to was, if you could diversify your exposure in regionals, hedged with volatility and equity, there's a ton of money on the table. And that's been a trade we put on mid-May, has worked out really well within the first few weeks. And we expect that there's a lot of runway left there as well.